Good afternoon, everyone. How is everyone doing today? We got quite a show to talk about today. Today, we're actually going to go over a little bit of what happened last week as far as the market goes, which is up a pretty healthy amount. We're going to go over the macro disinflation that's happening with the macro data. We're going to go a little bit over the AI bubble or what's perceived to be an AI bubble. And then we're going to talk about what we think 2025 is going to be and closing off about these software earnings. So to start everything off, I just kind of want to go over some charts here for the performance that we had last week. And here we go. Yeah, that's right. I was looking at Fubo. That thing was acting pretty wild toward the close last Friday. I'm going to go over here and look at the 5-day chart here. Take this stuff out. So pretty much last week was pretty insane in terms of the gains for the S&P 500. We were at 3.87% on the market. For the Qs, we were at about 4.73%. And IWM, we were about 3.33%. A lot of few things happened last week, namely with the CPI release. And I did release a macro update video on this. I think it was about on Wednesday or Thursday. But basically talking about how disinflation is still in the camp. Now, it's not exactly deflation, because when you think about deflation, you're thinking about it. You're thinking about CPI actually going down on a negative percentage basis. But what's actually happening here is that CPI is actually decelerating. It went down to, I think it was about 3% versus the previous quarter, which was north 3%. And the point that I was trying to land with that was that basically CPI was kind of accelerating, had a little bit of a pump going on, but lately it has been continuing its downtrend. So as far as that whole theory goes that inflation is going to come back, inflation is going to be sticky, I really don't think it's going to be sticky at all. I think it's going to continue to decelerate, continue to disinflate. And then we also have additional factors that are also deflating factors and downward pressure on inflation, which is pretty much AI or accelerated computing. The more you can automate certain processes and certain tasks that are done by humans and more toward code or machines, that's basically going to decrease the demand for human labor for certain mundane tasks, and therefore pretty much decrease the price per capita for humans. For work or labor, for that matter. So let's continue looking at exactly what happened last week in terms of the sentiments. I'm going to share that screen here. Hold up. All right. So, let's see here. Okay, cool. So I wanted to bring up the AAI sentiment survey, and again, I did release this for the Discord members last week, but just to kind of go over, the AAI survey came out last Wednesday. Last Wednesday evening is when the survey ended, and they released the results on Thursday. So we went from about 40.5% bullish on the sentiment indicator to 42.5%. And then bearish, we went from 37.5% to 28.9%. Now that's nearly an 8% or 9% drop on this indicator, which basically means that a lot more people are actually bullish to market, or a lot less bearish to market than they were. However, we did notice here they went from 22% to 28% on the neutral indicator, which means that there's a bit of uncertainty still in the market. Now, this was on Wednesday as of close, or Wednesday midnight. And we can tell, what was it? The market rallied pretty hard, actually, on Thursday, the day after CPI came out. The market rallied pretty hard because of the jobs report that came out for the jobless claims. That actually came out a lot better than expected, meaning that a lot less people filed for unemployment that week. New people filed for unemployment that week versus the previous week. So that was definitely very good data. And of course, now we're returning into the regime where good news is actually good news this time around, versus good news was bad news last time. And then bad news was good news. So then now the good news is actually good news, and the bad news is actually bad news. I don't know. The market likes to flip flop back and forth like that. But at the end of the day, I mean, we had good data. It doesn't appear we're going to recession. as far as initial job claims go, because if we were, that would trend much higher, especially on a 3-month rolling average basis. But that definitely is not happening. The market rallied on that, even though CPI was kind of in line. They seem to be focusing more on the job reports. And in this case, the job reports were good and the market rallied like 3% that day, which is pretty crazy. One thing to note, though, is that I'm going to share this tab. The CME Fed tool. And I don't know if you guys use this, but I keep sharing this every single week because I think this is pretty important. This is basically the data that, it's the market that is pricing in how many rate cuts, whether we need a rate cut, rate hike, whatever it is. But in this case, for the September FOMC, we still have 100% chance, 100% chance that we will get a rate cut in September. We're at about 75% for one rate cut and 25% for 2 rate cuts. And the thing that I pointed out with this chart before was that if we look over here for the probabilities of 2 rate cuts, 1 month ago, it was 3.9% chance of getting 2 rate cuts. 1 week ago, it was 51%. And then 1 day ago is 25%. And this is as of today. So like the data really hasn't changed since yesterday. But I do remember when we had that massive sell-off on Monday morning regarding the yen carry trade, or what people think was a yen carry trade unwinding, it was at about 75% chance of 2 basis points, of 2 rate cuts, which is 50 basis points. And that was a little bit extreme in terms of that. And there are actually people who are talking about an emergency rate cut, which is just, we're not going to get an emergency rate cut. When you really think about an emergency rate cut, if the Fed were to do that, they would really lose a lot of credibility with that. Basically, they have their whole idea of how they're going to start the rate cut cycle. They could see that the data is starting to slow down, which is great. Inflation is starting to decelerate, which is great. Disinflation. But to come in with emergency rate cut would not necessarily be good news for the market, because it would show a sign that the Fed actually sees something pretty bad happening, and we need to get in front of this by basically going out of our cadence and what we are expecting of just doing 1 rate cut, and we need to put a rate cut ahead of the actual meeting. And if that were to happen, to be completely honest, I don't think that would be bullish on the market, because it just means that there's uncertainty that the Fed is seeing that they have not disclosed to the market at the time. So really, when we come into this FOMC meeting in September, we're probably going to see 1 rate cut, at least a 75% chance we're going to see 1 rate cut. For this 25% for 2 rate cuts to actually come up, the thing is that for that to happen, we need to seriously see like material breaking of the unemployment. We need to see probably unemployment go like north of 4.5% now, because I think it was like 4.4, 4.2% last time. We need to see it to go probably at least 4.5%, which is more than what people expect in terms of unemployment. We need to see job claims pick up back again, and we definitely need to see those ADP payrolls to drop like a rock, basically meaning that there's less people who are working in the market in terms of new jobs. So, again, everything's looking pretty good. I personally don't see a recession coming up. I know a lot of people are really talking about it, but for me personally, I don't think a recession's coming up. I'm kind of in that camp. There is a bit of a scare in terms of a recession, but there's a pretty good likelihood that this is just a scare, because there were supposed to be like 4 recessions in 2010, and that really just never happened the whole time. So that's for the CME Fed tool. Actually, let's take a look here at what the rates will probably be at the end of the year. So this is target probabilities for the December 18, 2024 FOMC meeting. And this is pretty much going to tell you what rates are going to be at the end of the year, at least what the market is pricing in terms of the rate. So we have 450 to 475 basis points, which means that we're going to get a 41.1% chance we will get 3 rate cuts by the end of the year. There's a 42.7% chance we're going to get 4 rate cuts by the end of the year. And then there's a 14.5% chance we're going to get 5 rate cuts by the end of the year. And what I did go over here before that jobless claims report came out, actually, we see here 440.25. So this will be the 5 rate cut mark right here. It's 14.5% probability of that right now. But a week ago, this was 25.3%. So there was actually 1/4 chance or 1 out of 4 chances that we would actually get 5 rate cuts by the end of the year. And I believe when we had that yen carry trade unwind, the market was down during that period of time. I think this number was probably like 40% or something. So what that is basically trying to say is that when the market is pretty much falling, that pretty much means there's a higher chance we're going to get a rate cut. So if we think of this in terms of I wouldn't say cause effect, but let's just say correlation. The more the market goes down, or sorry, the more rate cuts that are priced in means that it's bearish for the stock market. But having just enough rate cuts is bullish for the stock market. So this is kind of the weird situation that we're in here. And this is why I was saying before, where it's like good news is actually good news now, because the market wants to see inflation deflate or disinflate. They want to see inflation decelerate over time. What they don't want to see is it to decelerate to the point where the Fed will actually have to start cutting rates rapidly to circumvent that, because the unemployment market is crumbling. And I don't think there's going to be a downward spiral in the unemployment market. I think things are going to stay pretty good. I think there'll be something of a no landing to a soft landing. And when I say no landing, I mean like we're not really going to see any impact on the entire economy as far as the jobs data goes. There would be kind of a factor of the job market normalizing versus deteriorating. When we think of deteriorating job market, we're really talking about like high 4% unemployment and increasing rapidly and getting out of control. When we're talking about normalizing, we're talking about like staying in the 4% and not growing from there, right? We had like maximum we had like maximum employment probably for the last couple of years ever since COVID happened, and people just got too used to that. And in actuality, you know what? Let's take a look at the data here. Let's see what the average unemployment rate has been for the last 20 years. About, I'm going to share this screen here, and then let me do the unemployment rate. Oh, great. Unemployment rate by country. I don't want to look at that. Watch. Every single time I open it up on this stream, like I always get confused with what the hell I'm doing. So, okay. So this should be it. This is by percentage, which is great. So let's take a look at unemployment when COVID happened. 14.9% unemployment. That's crazy. So going from going from 2010s, unemployment pretty much started out and started trending down. You could see that constantly happens here. But if you look over here, a 3.5% unemployment rate or somewhere in the mid threes is not the average here. The average would be actually be around 4.5%, somewhere in the mid 4%, right? Just basically looking at this chart and just seeing how what the trend is here. That is pretty normal. I don't think we're going to see this huge spike up in unemployment that we've seen preceding other recessions. I think what we're going to see is kind of like, around staying a little bit flat here and not seeing it trend anymore up or trending anymore down. You're just kind of staying around the Goldilocks, not too hot and not too cold. And that is exactly what we need right now, because we could see that GDP is actually doing very well on a quarter-over-quarter basis. And sticking with unemployment around this level, I can really see the market continuing to just propel up, especially with the innovation technology that's coming out nowadays. So yeah, I mean, that's pretty much it. What did ETF FaceTime say? Do you want good news or the bad news? Well, the good news is the bad news, and the bad news is the good news. Yeah, I mean, like it's just, I mean, I want good news, but not like too good news, because too good news would mean that the Fed doesn't have to push on the, I guess in this case, push on the accelerator in terms of spitting money into the economy or pumping money into the economy. I think good news would be good. I still think the terminal rate for the Fed is somewhere around 2.5% or 3%, which I think is perfectly fine. We're not going to get 0% interest rates anytime soon. I think that's like very last resort in terms of what the Fed might do, because 0% interest rate would pretty much put inflation out of control unless there's like some sort of huge deflationary force on us. Like there was just like a lot of talk that like I think Kathy Wood was saying that China is exporting deflation, and it's like, okay, like don't get into that, Kathy Wood. First of all, you're like buying like the shadiest stocks in the stock market. But second of all, for China to be able to export a lot of deflation to the point where it's actually impacting our economy, we would have actually seen that by now, because China has gone through probably the worst productive period in the last couple of years, and their stock market has not came back. we would have seen that by now. And really, we haven't really seen that, to be completely honest. At least I haven't seen that in the data that comes out. And the demand still stays pretty strong in terms of technology and accelerated computing. So, good news is great, but I don't want to see like exploding, like, oh, this is amazing news. Unemployment's coming back down to 3%. I doubt that's going to happen anytime soon. So that is that. Oh, actually, there's one more thing I want to take a look at. I actually forgot to do this in the video that I had the other day, and that is the CNN Fear and Greed. Let me share this tab. So a lot of you guys probably know about this, the CNN Fear and Greed Index, and this is less of a survey and less of what the market price is in, but more of like what's the word I'm looking for? It's more of like a technical indicator, and it's mostly on past historical data. It's not necessarily forward looking, but this is really based on 7 factors in the markets. The first one is a stock strength price index, so net new 52-week highs and lows on the New York stock market, the stock market breadth, put and call option, market volatility, or the VIX against its 50-day moving average. Safe haven, how is there a lot more money, or are bonds outperforming versus stocks outperforming? Junk bond demand, blah, 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 whatever. Based on all of this, we're at about a 35. Oh, good Lord, that is a humongous ad. We're at about a 35, which still puts us in fear territory. We were actually in extreme fear territory for a while. Like you could see here last week, we were at a 23 in terms of extreme fear. And the market was like kind of hitting those lows, actually, let's take a look at the charts, because there was something I wanted to actually go over. How the hell do I switch from, I can't just like switch what I'm presenting by window. I have to go out and go back in. All right. So over here on the SPY chart, all right, when we had that massive dip on Monday, we went up, the market rallied, and then it came back at the end of the day. And then the market rallied, and then it came up by the end of the day. And then the market rallied, and then this was the day where it didn't do that. Like people expected it. Like if you saw over here on Monday, the market opened at like its lows pretty much for the day. It dropped a little bit, but it really opened at its lows, and then it just rallied up the whole day. But what we do notice here, let me go on the 1 hour chart, and then I'll go back to August 5th, the day that no one's going to really forget for a couple of weeks. But the market opened, it dropped a little bit. Actually, no, this is the pre-market. Everyone was like screaming with their heads off. The market opened pretty much near its lows, and then it ripped up, and then it kind of faded throughout the entire day. This is like a 2% fade, actually, when you really look at this chart. That's a pretty big fade in terms of SPY. And then of course it rallied overnight, and then it pulled back toward the end of the day. And then of course it rallied overnight and then pulled back as soon as it's open. And I bet you people were shorting the market on Thursday, last Thursday, not the Thursday before last Thursday. People were pretty much shorting the market, and the thing just ripped up. And then probably around here, I remember seeing so much bearish crap on Twitter. People were like saying that we're going to hit the new lows. Oh, that's so uncertain right now. Like what's going to happen with the market? And it didn't drop on Thursday. And then Friday came along, it didn't drop. And going toward the end of this week, I still remember there was so much fear in terms of sentiment in the market. And I looked at the positioning in terms of the futures data on ES and the Qs and NASDAQ and Dow Jones and Russell 2000. And like people were still positioned to be bearish on the market, which is like you had like a 7% dip, right? Like people are like, oh, we're going to get a correction. We're going to get a correction in the market. We're going to get a correction. And it's like, we kind of got a correction. The market dropped like 8 or 9% in the matter of a few weeks. Like, what do you want? You want a new bear market? Like, you're not going to get it. You had that in 2022. But yeah, the market continued to ride up, and it made a crazy week, ending at about a 4.3%. Like, this is just what it's going to do. Like, the bad news wasn't that bad, and the market just kept picking up. Anyways, I'm kind of digressing on this topic for the last 20 minutes now, so I will move on. Otherwise, I could talk about this shit all day. But one thing I wanted to bring up that's actually going to make this week a pretty big deal is, hold on, bear with me, guys. I'm getting used to this thing. All right, new tab. Okay, so Jackson Hole Symposium. What the hell is the Jackson Hole Economic Symposium? Now that's a mouthful. The Jackson Hole Economic Symposium. Jackson Hole. There's also Jackson Hole Economic Symposium, Jackson Hole Symposium, Jackson. It's like, okay, we're going to have Jackson Hole. So basically, this event is the Fed is getting together, all the members of the Fed and whatever, they're getting together for like about 3 days, August 22nd to the 24th, I believe. Let me double check here at my calendar, actually. I don't even need to look at calendar. I could just bring it up over here. Yeah, the 22nd and the 24th. So they're gathering on Thursday and then they're going to be leaving on Saturday. And what basically is they're going to talk about where the monetary policy is right now, where they think the economic data is going to go toward throughout the next year, and what their plan is to attack this for the whole year. People are like getting ready for this. When I say people, I mean like, what do I see on CNBC? What do I see on Twitter? This seems to be like the talk of the town right now, as far as like what is Powell going to say? Is he going to be dovish? Is he going to be hawkish? Is he going to do rate cuts in September? Or is he going to do rate hikes in September? Who knows? At the end of the day, this is going to be the most BS meeting I've ever seen. Like, he's going to go up there, he's going to say the same shit he said every single time he's gone on the podium, giving very little information as to what they're going to do, probably figuring out what words to say to not screw everyone over, to not have the market drop or rally 10%, and just basically give it a whole lot of nothing. He's not going to give us any more information, and the markets are probably going to rip after that. I mean, that usually what happens. The market prepares for it. It braces itself. It's like basically if you're about to get punched in the face, or sorry, if someone says, I'm going to punch you in the stomach, and like they're dead serious about it, like you're not just going to stand there and just take it. You're going to kind of like tighten your muscles. You're going to prepare for the punch in the stomach, right? The market's kind of doing the same for this, right? It's probably not going to go anywhere until he speaks on Friday morning, and maybe it does, maybe it doesn't. But when that meeting happens, I don't think anything's going to happen. And then after that, the market's going to rip up after that, because that's just what it usually does when there's no bad news. Kind of think I don't think it's a non-binary event. I don't think anyone should buy puts. No one should buy calls. Just chill, just see what's going to happen. If you really wanted to buy in the stock market, the day was the other Monday. If you're buying now in the stock market, you could be buying into a whole wave of just nothingness, probably for the next couple of months at least. But yeah, this event, I don't think it's going to be anything crazy. But yeah, Powell is talking. I believe it's when is Powell talking on Friday? Jackson Symposium, Fed. Okay, he's talking. This is actually Pacific time. He's talking at 7 a.m. Pacific. So 10 a.m. Eastern, which is 30 minutes after the market open on Friday. That is when he's talking. And yeah, I mean, a whole lot of nothing. We actually got some data coming in this week. Let's see here. The biggest one probably. Yeah, there's a lot of Feds talking. Yeah, FOMC meeting minutes from the end of July is actually coming out on Wednesday, 11 a.m. or 2 p.m. Eastern. Jobless claims again on Thursday, as we do every single week. New home sales actually is on Friday. That's a pretty important one. We got the 30-year tips auction. That's really not that important. Existing home sales on Thursday. Yeah, I mean, to be honest, the market's going to be looking forward to pretty much Powell speaking on Friday. So yeah, I mean, that pretty much is it for this week. I don't really think there's much else to talk about. We just wait for the meeting on Friday, wait to see what's going to happen in the market by then. All right. So moving on to the next topic, there was supposed to be a debate on the supposed AI bubble, but we're probably just going to talk a little bit about demand for data center power. That's something I've actually been noticing recently, been reading a lot about, is the demand for power to electrify these data centers. The demand is going up pretty high. Actually got some... I got an article from Goldman Sachs that I wanted to share here real quick. Here we go. Oh, Rob said something. Jackson Hole rattled the market in 2022. But yeah, I mean, in 2022, Powell came up on the podium. Jackson Hole. So that was August 2022. Powell came up on the podium and he's like, yeah, we're going to increase rates. Inflation is crazy. See you guys later. Like he was on there for like 2 minutes and he was just like, we're going to increase rates, guys. Inflation is crazy. We can't handle this stuff after saying that it was transitory for like 2 years. But 2023, that dude was up there for 30 minutes and he didn't say anything the whole time. Like he was saying everything we already knew. Basically that we have to fight inflation, data dependent, and just wait and see, guys. And that was pretty much it. But that was after the rate hike cycle ended. So it didn't sound like he was going to increase rates or hike rates again. He just basically said, like, we're going to keep doing what we're doing. We're data dependent, guys. So just chill. This year, I think it's going to be the same thing again. He's not going to say for sure that they're going to cut in September because he can't give that information away. But he's going to say things are looking good. The economy is staying robust, or the economy is modestly slowing down, or unemployment is modestly rising. Some crazy words he's going to say, and it's going to be a nothing burger, to be completely honest. All right. So what are our thoughts on MPOX, particularly regarding the cruise lines? I'm not a medical expert, and I got to be honest, I wasn't reading too much about the monkeypox incidents that are happening around the world. But if I do recall, okay, and don't quote me on this, I'm not a medical expert, is that more people die from the flu every single year versus monkeypox in the US. So is this going to be something that extreme? I don't know. I mean, we've been dealing with monkeypox for a long time. When COVID first came out, right? I say when COVID first came out, like it was a movie that just came out or something. But when COVID started in the world, started becoming big news, like no one knew what COVID was. Yeah, it was a strain from the flu or whatever, but like no one knew what it was, right? So people thought it was going to be like the end of the world or something. But monkeypox, this isn't anything new. Like we've been dealing with monkeypox for centuries, right? And I don't know if we have a vaccine for it or anything, but do you really think that even though we just had COVID 4 years ago, right? The whole world went on lockdown. All these hospitals beefed up their staff and everything. They prepared all their equipment they had there. They have all the breathing machines, whatever. Like, do you think that the same type of preparation that we had for COVID, which was basically unprepared, to now, like, if that were to happen, I think we'll be pretty prepared for it. I don't think that the monkeypox is gonna like come this big thing. It's like, holy crap, where did this come from? No, I think there's like a group of scientists like meticulously watching this data like every second, just making sure everything's gonna be fine. I don't think it's gonna be a big deal. But I mean, I don't know. Something can happen from it, and I can't really predict that, but I'm certainly not gonna go YOLO puts in case that's gonna happen. We'll see what happens. I'll be data dependent. I'll be data dependent on that. But yeah, I mean, God bless those souls that are actually impacted by the monkeypox. Hope they have a good recovery. So the thing I wanted to go over was oh, I got a little bit distracted. Let me open it up here. All right. So this is an article from Goldman Sachs. This was actually released last May. And don't let this go make you go balls to the wall bullish on the market. But I'm just looking at it. I'm just being data dependent. But if there's some charts that they have in here, which is pretty interesting. I read through most of this. It's just blah blah blah. It's talking about AI demand, data centers, and all that stuff. But I mean, there's some pretty interesting charts in this where they basically talk about the data center demand, including AI and without AI. And I think what they're referring to when they're talking about AI is accelerated computing. How they actually measure that, I'm not exactly sure, but I'm looking more at the trend of this, not so much the actual numerical values of the data here. But this is where the estimate comes in. The estimate comes in basically past 2023, and they take the data every single year. I think, yeah, it's every year, and they look. They expect, let's see here, for just the US alone, they expect this to increase linearly, not exponentially, just linearly, straight line up. And that's including AI. But without AI, they do expect the demand to still come up, right? But if you include the rest of the world, and this is something that Jensen Huang talks about a lot, especially in the last earnings call, is the sovereign AI. When they talk about sovereign AI, what he's basically referring to are data centers with large language models, training, inference, and all that stuff, basically beefing up the data centers outside of the US. For it could be for private companies outside of the US, or it could be for public companies outside of the US. And the reason why this becomes important is because most of the data centers that are that are powered by the hyperscalers, AWS, Google Cloud Platform, as well as Microsoft, most of them reside in the US with certain regions outside of the US, but like nothing in terms of like Saudi Arabia building a huge data center or something like that. That's kind of what he was alluding to. When I say he, I mean Jensen Huang was alluding to on those conference calls, as well as other CEOs as well and other companies during conference calls. They talk about the demand is actually starting to pick up outside of the US, outside of mainland in Europe, or even China. And when you kind of see that demand pick up, then you have to start building energy reactors, maybe nuclear reactors, power plants, start burning coal, start buying oil and all this stuff in all these other countries, which is showing because the demand for the power inside these data centers is actually increasing. That actually is going to drive GDP around the entire world. So, we'll see. I mean, I could kind of see this chart playing out. And again, I don't know exactly where they're pulling in this data or what the sources are, but what I could kind of see playing out from this chart is that demand is still pretty high in terms of powering the data centers. When you think of AI, don't think of it like everyone's got to buy the NVIDIA chips and install them in the data centers. Think of it as accelerated computing versus AI. So accelerated computing would mean that the demand for power as these companies are growing around the US, like let's say you're running a company, right? You have 100 clients, and then the next year you have 200 clients, right? So you're not going to run them in the same infrastructure. You're going to build more infrastructure to support all of the clients that are running servers on your end, right? So you're going to build more infrastructure, which needs to be driven by power, and then you're going to need the power, which is adding to the demand that we're seeing in this chart. You're going to need the power, whether it's going to come from nuclear, oil, natural gas, whatever it is. You're going to need that power, and that demand is increasing exponentially. At least it seems like here for the rest of the world AI. Actually, if we would look at the difference here between XAI and with AI, like the difference isn't significant. Yeah, I mean, we're just talking about like, about 100 terawatts. It's like nothing, man. That's like chump change. That's a lot. 100 terawatts is a lot. And this is something that was pretty interesting here, because if you look at the trend here for estimated total data center workload demand, this is increasing pretty exponentially. This was actually flat. Excuse me. Data center power demand was actually pretty flat for 2015 all the way until 2019. And then COVID happened. And look how this thing just shot up. I mean, you kind of saw, like when COVID happened, all of these companies were really coming out of nowhere, running compute and data center like to the millionth degree. And the estimation was rising up in the last 5 years of the 2010s, but we were kind of seeing flat power demand until 2020 when COVID spiked up. And you could see that now the data center power demand is actually increasing exponentially along with the estimation line. So, that's something too. And the sectoral growth in the U.S. power demand, yeah, I mean, you could already see the demand is increasing. This is the CAGR that they expect from 2022 to 2030, and out of all of these numbers, data center is the highest CAGR for increase for U.S. power demand out of pretty much most of these sectors. Residential is 0.6%, commercial 0.4%. Actually, that's pretty interesting that commercial is 0.4%. I don't know what represents commercial. I guess commercial would be on-prem data centers, which considering, when you think about 90% of all IT infrastructure is hosted on-prem and only 10% is hosted in the cloud, meaning on the hyperscalers. We could kind of see that number not increasing as much as the hyperscalers increasing or the data centers increasing capacity for U.S. power demand. But overall, from 2022 until 2030, Goldman Sachs sees a 2.4% CAGR in U.S. power demand. So 2.4% every single year. That's a lot. I mean, when I see data like this, and this isn't the only place, like I'm not just looking at this chart and just thinking like, dude, buy calls in NVIDIA right now. I look at this chart and this is just like one of the things that I kind of factor into my thesis on where I think AI is going. Is AI just a bubble and is it hype or is it going to pop? And this whole thing's a sham. Really, in my eyes, I don't think that it's a bubble. And if it is a bubble, I don't even think we even started to see what was going to happen. I do think that we haven't yet seen the demand really pick up to the level, because there's a lot of companies out there that are looking at that they're looking at the LLM use cases. Like when ChatGPT 3 came out in late 2022, all these companies saw that, and they're talking about AI making all these promises in their conference calls, spending all this capex, saying like, oh, we're going to make so much money off of this, right? And then at some point, I think it was around late 2023, companies started saying like, well, we're not really seeing any capitalization from this, but we do expect it to come, right? And then all of a sudden now it's like no one really talks about it as much anymore, only because of the fact that the CIOs did realize like, hold on a second, if we're going to capitalize off of this isn't going to happen like right now. This is gonna take a little bit of time. We got to figure out the use cases for it. We got to test out these use cases with certain clients, and then we got to see, are you guys willing to pay for this? So we're gonna start offering this new service to they have this thing called in preview before general availability, which means that only a subset of your clients actually do try out these new features. And depending on how that goes, we'll roll this out to general availability or to everyone else, and then we'll expect those revenues to come in. But right now, I think the problem is that the market at least expected the growth from the AI revenue to come now. And that's what they're pricing in on a lot of these stocks. And that didn't happen. So people are starting to get a little bit discouraged on that. People are starting to think like, oh, maybe this whole thing is sham. Maybe like it's going to happen, right? You're going to start seeing the demand for all these LLMs come, and you're going to start seeing the small language models come for a lot of companies, private LLMs, which means that they're hosting all of the trained models on-prem, and they're not reaching off-prem, meaning that they're not going to reach out through the internet and possibly give away data. And or hold on a second. Oh, hold up. I got to shoot Kris over a link. You guys are about to hear the other side of this, because this guy does not agree with me on this. So this is going to be pretty interesting. Man, I need some freaking water, dude. Okay. So, all I'm saying is that, if you got calls for NVIDIA expiring in a couple months, like y'all need to chill. Like this is going to take a little bit of time. What is good, man? How you doing?
Dude, my bad. I was up all last night reading, and I slept like you know me, I work at night. So
Yeah.
so today I was sleeping and my phone died. And so it's funny, you know how I woke up? My wife called the Alexa that I have in my bedroom. She's like, "Honey." She dropped into the Alexa and she was like, "Honey, don't you have a pod with Sam today at 4:30?" I'm
Yeah.
like, "I think so." I was like, wait. So I was like, how do you know? She's like, I got the alert. She's a subscriber, right? So that's how she like
That's
she woke
funny.
me up.
That's funny.
So
Yeah.
my bad about being late.
Nah,
Yeah, I
it's all
just
good, dude.
literally
It's all
woke up.
good. Yeah,
Yeah.
like actually, this guy was waiting for you, and I don't want to say shit because it'll be like, I don't know if he's coming or not. Like this dude just like worked until 4 o'clock in the morning last night. I don't know if he's gonna show up, but yeah. Welcome back, man. I hope you had a good. I hope you didn't have a crazy shift last night. I didn't even
Nah,
know
it's
you were
just
working last night. Was that because you were
no.
off?
I
Yeah,
wasn't working. It's just you know what it is when you work like these. When you work the night shift, right? It's like some days. So I just got back from vacation, right? So my thing is, I was at. Hold on 1 second. Sorry. So I was shifting back and forth between timings, right? So it's like you get used to the 12 to 8, and then you get used to like sleeping at a certain time, and then comes a vacation and you're like, okay, now I'm going to be awake for during the daytime, and so now your internal clock gets reset again. So then you have to kind of like force yourself to reset, because I'm working tonight. So the thing is, like, if I stayed awake all day today, then I'd have to stay awake all day at night, So now I have to be awake 24 hours, and then the market open tomorrow. I'll be like, so I don't know. One of these days, man, I just gotta quit my job. I can't do it anymore. Like I can't do the overnights. But it's gonna be a little while before that happens. So we'll see. I think you're muted, brother.
I just flipped this around because I was looking in like
I know, it's weird.
Direction.
Right?
Yeah. Like I was looking in this direction, you're looking that direction. This is weird. When I flipped it around, like, hold up. Wait. Okay. Let's flip it.
No, dude. Even if you see it on your StreamYard, it's still gonna look like it's off. We have to figure out, either we have to do it via the camera or something to make sure that we're facing each other. Otherwise, it's gonna look like we're both. Well, I mean, it's fine. I mean, I guess
right now we're looking the same direction.
Yeah,
we're looking at each other. But sometimes, like when like what they got picked up on pretty good is that there's certain podcasters where like they're looking like I'm looking at the camera right now. I'm looking at y'all right now, but then there's some podcasters like us where it's just like I'm looking at the computer screen. Like I don't care. I don't care about you all. I'm looking at the computer screen, right? So I know Ahmed, he looks right at the camera, and me, Kevin, looks right at the camera. And obviously, if you're doing a recording, you're looking at the camera. But then there's like us, and Matt. We look in this direction. Steven looks at the camera.
Yeah. I mean, it's a personal preference on how they want to do it. For me, the reason why I don't do it straight on is because sometimes it feels like it's a distraction. Like I look more at the camera than I'm looking at the screen, and sometimes I need to focus on the screen because me, I put up data points all over the place. So I like the setup that I have. It looks good.
Cool. So I was talking with the crowd about. Okay, let's get into this, dude. So. I was sharing this. Wait, what the heck? Oh, I changed the scene. All right, so I was sharing basically AI power demand. I was looking into this during the weekend about demand for power to the data centers. Now, in this chart, this chart is basically showing that AI power demand is increasing linearly, but this is more of an estimate, so it might actually come in higher. But this is what Goldman Sachs expect AI in terms of terawatts for demand to be through 2030. What I found interesting about this chart was that the rest of the world AI is increasing at a faster rate than just the US. So that's where the sovereign AI really comes from. Building LLMs outside of the US is what they do expect. And they even expect everything outside of AI to increase at pretty much similar demand scale. And what I found interesting here was that the estimates went up before 2020, but the demand was kind of flat. And then COVID happened, of course, and everything got built online. So that's why everything started going up. So the demand actually followed the trend. And then something else here was that this is kind of expected. How the demand is the highest for a data center as far as a CAGR goes until 2030 from 2022. I don't know what other is, but it looks like that's minus 0.05%. But commercial is one of the least growing ones. And then, of course, there's residential. So what I was trying to say is I'm using this as my long-term thesis that accelerated computing, not AI, accelerating computing is still going to be high in demand through 2030 at least. And I was going to move on to the topic next to talk about 2025 because I know you're discussing this as far as like, what you think 2025 is going to be. But what's your take on AI demand, man?
Well, outside of AI demand, I think I saw some data points that just said even just regular cloud computing, regardless of AI, is still going to be CAGRing at almost a 15% clip for the next 10 years. Because I think a lot of people think, oh, is cloud computing finally over? And I'm like, yeah, no, it's not. No, it's not. There's still a lot of things that are on-prem. And then also the amount of workloads are getting bigger and bigger. So if you think about it, there's still going to be more AI data center demand, regardless of AI. So this is where I would say, if you look at certain companies, there's three major companies that are going to benefit, of course, the Googles, the Amazons, and the Microsoft of the world, because they have the money and the resources to put in. I mean, the way I see cloud computing and even AI compute, if you think about it, Sam, it's like a giant, like REIT, right? I mean, yeah, it doesn't pay dividends, but if you think about it, what does a REIT do? A REIT buys property, extracts cash flow, takes that cash flow, buys more property, right? And it just keeps doing that over and over. And then what happens is they take some of the money and they distribute it to shareholders, right? The way that these players are doing it, they're doing the same exact thing. They're going out there buying land, they're building data centers, they're building all the infrastructure, right? Selling the or renting out that you know that space and that compute to all these companies and corporations. They're extracting money from them, getting a margin from that, and then using the money to one, build data centers, but also return cash to shareholders by doing massive share buybacks. I mean, it's such a crazy business. I think a lot of people don't necessarily understand that about cloud computing and how still there is a long way to go for us to like top out. And I don't even know if there is a point where anything even tops out, you know? So I would say if you think about like long term, um some of these companies are definitely places you want to be during a recession, because if you think about it, even if we have a recession, no one's going to say, okay, yeah, let's cut back on our workloads. Like that doesn't happen. You know, you might see a valuation reset on a multiple basis on some of these companies, but in terms like long-term investing, these are companies that you want to be in. So as an example, one of the things that I'm worried about right now is a recession in 2025. Now there's a whole bunch of reasons why, but we need a trigger to happen in order to get to a recession. And we could, we'll have this discussion a little bit further. But I agree about the AI compute thing. I think AI compute is still in its infancy. The only thing I'll say about AI compute, though, is that I typically don't like being in the hardware part of any revolutions, right? So if you think about like the 2000s and so on, we had this point where everyone was valuing the hardware players like Cisco and Lucent and everything else like crazy. Like, oh my God, these companies are the ones that are gonna like dominate the world when it comes to the internet. And it turned out that that wasn't necessarily the case. It was actually the people who created the application value that's on top of this. So I would say if you were asking me, Kris, like what part of the value chain do you want to be in AI? I'm not exactly bullish on the semiconductors as much as I'm bullish on something like CrowdStrike, right? And Palo Alto, because what happens is they can use AI to further accelerate their core products. And the thing is, like, their core product demand is not going anywhere. Like, if malware, antivirus, all these things are here with us forever. Like, it's almost like saying, when will crime stop happening? Like, crime will never stop happening. That's just how the world is. And the thing is, every year that keeps going on and on and on, you're going to see more and more money and development for better systems to keep up with the new viruses and malware that keep coming out. So these guys have like almost like an infinite loophole when it comes to money. And the thing is, once you reach a certain level of scalability, you're entrenched, and there's no way around it. Where now you're basically going to have number 1, 2, and 3 spots with all the other little guys fighting for scraps. So right now, I don't know what your thoughts are on CrowdStrike, but maybe that's something that we could. I don't know. I think I might have gone beyond the discussion.
Yeah. No, it's all good. I mean, what I basically got from that is that you're buying calls on NVIDIA as soon as the market opens. Not just kidding around. What I basically got from that was that, and I agree with you, is that like this is a revolution, but the revolution has been happening. Oh, should I say revolution? Evolution, right? This is an evolution of how applications are built, and okay. So let's just say I ask you, okay, build me a website, right? Or build me an application on the website, on a website. You have nothing. What's the first thing you're gonna do? You can't build a website without a computer, right? So you're gonna go out and you're gonna buy the computer, right? And then once you have the computer, well, you just spent your money. After that, you just got to pay maybe every couple of years. You got to buy a new computer or buy a new component, whatever it is. But like, you're not going to buy a new computer at least for a few years, right? And then between then, all you're really going to be doing, as far as your hardware goes, is just pay for the electricity that you're using, pay for your internet, whatever. And those are very minimal operating costs you're paying for. That's just OpEx, and it's not nearly as much as the CapEx you put up front. What do you think of data centers? All right. Let's just say buying land, right? You only buy land like really one time, or you lease the land from a company, right? So that's going to be a recurring cost that happen, but it's not nearly as much as when you buy the land in the first place, or when you build the building in the first place, or when you beef up the entire data center. That's the CapEx that really happens up front. What I kind of think is that the market is kind of overreacting a little bit in terms of the CapEx spend. Yes, Meta is going to increase their CapEx spend next few years, right? But there's going to be a point where they're not going to have to spend this much on CapEx, right? Where they really built everything out. All they got to do now is just build the applications on it or enroll the services, and that's when you see the revenue come up. I don't think people are going to see that crazy revenue ride in this year. I don't think it's going to come in for AI this year. Maybe middle of next year, I think it'll come in. But at the same time, the market can oscillate very high back and forth. It's always pricing the future in, right? So if you have a company that's not showing the revenue and they're not guiding as high because they did expect this revenue to come in very short term and it didn't, people are going to sell that shit off. That's the same thing you have with SMCI, right? Like people, that thing was trading for over 1,000 on some crazy multiples for a low margin business. Data centers and hardware is a very low margin business. And that's kind of what makes NVIDIA like kind of the cream of the crop, because one, it does build the best GPUs in the world. But two, their margins, their gross margins are as high as a freaking software company, dude. It's like almost 80%. I think it's like 75% or something. That's why they're getting that premium valuation. But a lot of that is driven on the pricing power for the GPUs. So people are talking about the AI demand. They're putting the ear to the ground because when this demand does start to slow down, which it will, there will be competition. They can't price their GPUs at this crazy amount. The thing that people got to remember, though, is that just because the price decreases, it doesn't mean people still don't want this stuff, right? And they're releasing new lines every single year, right? The Blackwell is coming, the Blackwell B200 is coming out at the end of the year. And then they're already talking about Rubin, which is going to come out in a couple of years, right? And then before that happens, they're going to release, I think, the Blackwell Ultra, a Grace Blackwell Ultra GPU. So they're always going to release new stuff. AMD will never catch up. They won't. Like AMD is never going to catch up. But when you think about the demand, I don't think it really matters in terms of whether demand slows down or not. It won't be a crash, right? Like NVIDIA is not going to go from like being at, I guess it would be current split. It went to like 50 something and then it pulled all the way back to 10 something. And then now it's at, of course it's like a 120 something. NVIDIA is not going to pull back to like the 50s, dude. Like that's just, I don't know. That's just baloney. Like you have to see things materially contract. All right, go, man, go.
See the way that you're the way that you're looking at this is, you're seeing like, okay, yeah, if demand slows down, like what's going to happen is there's going to still be like a lot of forward demand. But you have to remember the market doesn't always trade just based on fundamentals, right? The fear can cause the sell-off to get it back to its lower valuation. So if you look at a lot of the things that we just happened to us, like literally it was like 3 weeks ago, where even the smallest amount of fear started entering the minds of the investor. And now you had these great companies get sold off like crazy, right? So when a lot of these like things happen, where you have like fear that creeps into the investor mindset, valuations, we can try to justify them all we want. Like, oh, look, this company is undervalued. It shouldn't be sold anymore. And it's like, no, the sellers are going to sell. So I would say right now, the possibility that technology-wise, NVIDIA maintains leadership for quite some time. I totally agree with you. I don't think anyone really can compete with a lot of the stuff that NVIDIA can do. But that doesn't mean that a valuation reset can't happen. I mean, a lot of people say, look at Meta in 2022. Look at all of the hyperscalers and the big guys in 2022. Could you have imagined that all of these companies lost half of their market cap after 2021, especially how strong these businesses are? No, you couldn't imagine that. But the thing is, once the market gets fear into their brain, dude, valuations come down like crazy. And I think a lot of times what happens is you need to just sometimes wait it out and be ready to have cash on the side to deploy capital, so that this way you can bottom, you could bottom feed all of those things. I mean, think about all the people who made a crap ton of money on Meta when it turned $80, right? Now, the thing is, if you had asked anyone literally like 6 months before it happened, it's like, oh, you could buy Meta at $80 in a few months if you just wait. They would have laughed at you in the face, right? So one of the things that I would say is, yes, you can have a strong company, but that doesn't mean that the macro impacts of like a fearful investor won't impact the business overall. And this is where, you have to take a couple of things into consideration and say to yourself, like, okay, where do you want to be in this cycle, right? So if you start to see AI demand waning and you start to see a recession happening at the same time, and you see growth numbers starting to slow down, it could be a temporary occurrence, but people think that, oh, this is the new paradigm and I want to get out. And if they all sell at the same time, I mean, dude, we touched what, 92 on NVIDIA less than 2 weeks ago?
I got the chart up over here.
Yeah.
Oh, I'm getting better at this. All right. So I got the chart over here. So we reached the intraday high on June 20th on NVIDIA. And it was actually higher pre-market. I remember this, but the high was 140.76 and the low the other Monday was 90.69. So that was about a 36% drop, peak to trough. What more do you want, dude?
No, I agree that's a serious amount. But remember,
that was crazy. Like people came into that day and they're just like, sell NVIDIA, right? On August 5th. Like that's a 36% drop. Like what more do you want?
That's the point, that now that those fears have alleviated because they turned out that the data points that people were looking at were kind of like false positives, it recovered, right? So it's recovering right now based on, hey, we got a false data, right? But imagine the data comes out and it's a real data point where things are going south. Then what happens to NVIDIA? Do you think it stops at 92?
So Rob basically said this: NVIDIA can go back to the 50s. They have another 2022 type of market. I don't think so. Yeah, I wouldn't disagree with that. Like we have a recession. Like bring it on, dude. Like the NVIDIA is going to go down. Like it's going to go down for sure. Because when you think about a recession happening, companies are prepared for that. They spend less. They only spend what they need to spend. They start pulling back in capex and so on. And that just I just thought there was spam in the chat, but once companies start to contract their capex, then people are gonna sell NVIDIA because they're gonna be afraid that they're gonna have to spend money on chips and innovating and stuff, which totally makes sense. Yeah. Recession set aside, I don't think NVIDIA is going to 50 anytime soon. That would literally mean it'll be trading like a forward multiple of like high teens. That'd be pretty crazy.
That's what we have to figure out. Are we going, like, see, the thing is, recessions are inevitable, by the way. Everyone knows that. There's no like, oh, we already had a recession yet.
We had two.
I agree with you. I totally agree with you. But remember, if something happens, we always have to be vigilant. And as risk managers, we have to always keep like what if possibilities in the back of our brain. So NVIDIA could be impacted by two different risks. Right now, you have a general market correction and, things that, like, if you look at everything on a valuation metric, right? Valuation metric wise, a lot of things are overvalued, especially semiconductors, right? Semiconductors are trading at some of the highest forward multiples that you've ever seen. So number one, a correction in semiconductors could derail a lot of
what is trading at a high multiple.
Let's take a look.
Go for it.
Wait, was I just muted before, or did I just?
No, I heard you.
Okay.
I just heard it spaz out a little bit.
1 second.
Yeah, this guy is definitely long in the video.
Who? Of course, there's a lot of
longer video. Like this guy
there's
makes
a lot of
good points. Like I like this guy. I like you, LFC Jody. I like you.
There are a lot of people that are really long, and I agree. I think NVIDIA is a great company, right? There's no ands, if, or buts about it. Great companies are something that you want to be in, but sometimes the data points can show a little bit of counter towards that. So let's take a look at this right here. This is a forward multiple for just semiconductors as an index, not necessarily just NVIDIA, but NVIDIA takes up a majority of this forward sales valuation.
I think it's like 12% of which semiconductor index is this?
This is for, I'll have to look at it, but this is specifically for the semiconductor industry in general. And by the way, I think NVIDIA actually might make up about 30%, not really 12.
Well, it depends. I think if it's SMH, it makes up a larger percentage versus stocks.
Yeah. So if you look at this data point right here, you can see right now on a valuation basis, right? NVIDIA is up there. Like usually you have semiconductors, which typically trade between 10 and 20% forward, or not 10 and 20, but 10 and 20 forward earnings, right? Where you have like times where there isn't as much like, demand. You're going to see it kind of come down to maybe like 12, 13, 14s. And when, demand is high for a lot of things, it's going to slowly, make its way up. So right now on a forward basis, you're looking at semiconductors in general as a sector, like beyond that multiple that's out there. Now, if we look at NVIDIA in general, like by itself, like on a forward PE basis for, let's see, NVDA. Right now, based on $124 and for future targets. Remember, these are not set by me; these are set by analysts. On a forward basis, you're still looking at about 32 as a forward PE. You're basically buying something for a very expensive PE going forward, and that's with a 36% revenue growth this year. And by all means, it could definitely grow 36%.
So,
But
yeah.
even with a 36% growth rate, you're still looking at paying a large amount for this. So all I would say to anyone like looking at NVIDIA right now, I'm not saying it's a bad company. It's just the valuation could get hampered significantly by a reset in the market in general. But then you also have the market like overall outside of semiconductors. If that corrects and multiples compress, then you got a problem, right?
Hold on. I'm going to bring up the historical PE for NVIDIA. I can only do next. Actually, yeah, I'll just do next 12 months. Share this. All right. So, doesn't even matter if I do that. So this is their historical valuation based on their forward PE. We could see here that probably on average they got pretty expensive in end of 2021, early 2022, but what wasn't expensive during that time. But if you kind of like take a little bit of the average here, we're looking that they actually do sell. The stock is usually around 30 to 40 as an average, as far as their forward PE goes historically.
Well,
Given 2022 happened, they're actually pretty expensive in 2022. This is why a lot of people do say that NVIDIA is cheaper now than it was in 2022, because it was most of the time, right? Like if you look today, they're at 42.1 forward PE. So this is just for 12 months. This isn't 2025. So
zoom out,
is
do like 5 years or maybe 10. Let's look at that. I think that actually.
I think I have to do annual to go that far. Yeah, I got to do annual. So if I zoom out, on average between 20 and 40, probably a little bit closer to 30. So I guess historically they might be trading a little bit expensive. But when you look at how much NVIDIA trades, how far away it is from its mean versus the S&P 500, some people are like, I should just buy NVIDIA because it's probably a better buy at this point than buying the S&P 500. They're not really thinking so much about risk. If the market is risk on, which I think the market is kind of teetering between risk on and risk off, because there's a lot of fear in the market. I do think that NVIDIA is trading at about par to the S&P 500, but I can't really tell people like if they should buy NVIDIA or not, because it really does matter in terms of like how long they plan on holding NVIDIA, how big is their portfolio, how many shares you're going to buy, percentage or position size, whatever. For me, I've trimmed a lot of NVIDIA, probably in the high 120s, 130s area, down to about like 4 or 5% of my portfolio. And this is coming from having a large portion of my portfolio. I don't feel comfortable having a large portion of my portfolio in NVIDIA, mostly because I do think that it saw its massive growth, probably growth that we're never going to see for a long period of time recently. So I need to manage my risk. But at the same time, I don't think I would, if I were to short a stock in the semiconductor industry or in the hardware industry, it would be freaking Dell. That's what I would short.
Yeah.
I wouldn't short NVIDIA.
Yeah, definitely. I would never short NVIDIA, dude. That's just retarded if you think about that. I mean, from a risk management standpoint, these guys generate a ton of cash flow, which means that even if like the price goes down, these guys have the ability to buy back a crap ton of shares. That's how much cash flow they're generating. But that's also The thing to remember though is that remember that PE going down is primarily because what happened was all this AI stuff comes out, all the early people, what they do is they buy the shit out of NVIDIA. So now the forward PE skyrockets, right? So they see 1 or 2 quarters of growth. And a lot of these people start buying right away. They're like, look, even if it's on a 44 PE basis, this thing by next year, AI demand is going to be so crazy that the PE, even if I pay 40, is going to be fine, right? So a lot of people, they bought NVIDIA at 44 PE. And what happened is when the data point came out and they generated so much freaking cash flow, I'm talking about 300% growth in revenue.
It's got to level itself up.
The PE just crashed, the next couple of quarters. So I think what happens is people, when they look at the PEs, it gives you like this false sense of, okay, yes, this is what's going to happen and that's what's going to happen. So that's where I would say we have to be careful, because now you've gone from like a really bullish to now the bull thesis playing out, and now you kind of have to like ask yourself, okay, is the growth like sustainable to the level that NVIDIA is going to stay growing at 30%, 40% for the next 5, 6, 7 years? Because I remember the law of big numbers comes in, brother.
Did you look at?
Yeah.
Am I mute right now?
No.
Okay. Yeah. Did you look at the? Why don't you bring up what you had before? As far as the forward expectations for NVIDIA, they're not expected to grow over 100% by 2026. They're expected to contract down to like 30-40%, but they don't expect to go negative. The thing, I think what actually is going to become pretty important this quarter, and they have guided for margin contraction, but not a lot of margin contraction. That's the thing that's going to be looked under a spotlight, right? The margin contraction. So even though their revenue isn't growing, if their margins can still stay pretty high and they're generating, they're still growing free cash flow toward expectations, that's good enough for the market, right? But, oh, my bad. I'll share it. There you go. Yeah, so forward revenue growth is 2024, 100%. So we're like almost in 2024. Is this fiscal or calendar?
I think it's calendar.
Yeah.
Yeah.
Oh,
yeah,
this is what I hate about some of these platforms, though. But yeah, 36% by 2025. You're looking at a 75% deceleration in NVIDIA growth by 2025, and the market's cool with that. They're willing to pay 42 times forward price to earnings on that.
Yeah, I don't
know. I'll pay a forward P of 32 times NVIDIA, 36% growth rate. Like, that's cool with me. I'll pay for that. Like, they're cool with that. They're going to pay for it. Right. But it really depends. Like, if we have a recession, right? Like this baby's going to sell off. Of course it's going to sell off because margin compression is happening on the market as well. The PE of the market, what's the PE of the S&P 500 right now? It's at like 25, 26. Yeah. You had that Yardini research. By the way, Yardini research is bullish on the market. They don't think, Edward Yardini does not think we're going to have a recession.
Look at this thing, man. Look at this revenue growth number for NVIDIA. That's just
don't
nuts.
hate, man. Don't hate.
I'm not hating at all, dude. I'm just saying,
look at that stuff, man.
Operating income. Just look at this. Look at this monster, bro. Monster.
It's crazy. It's crazy, and there's never been anything like this ever. Like in the .com bubble, this stuff happened to the market, but it wasn't showing up in the numbers. It was just all hype.
But that was hype. On a TTM basis, though, just remember, like right now,
they got some crazy comps. Yeah,
they went from contracting year over year on a quarterly basis from 2021. Because remember, this is what happens with semiconductors. They have cyclicality built into their business model. So you had like the growth of Bitcoin and everything. So they were rising. They went from 83 to now going down to -20, and now they're up to.
That wasn't data center growth. Okay, what happened during 2021 was not data center growth. That was it's not called gaming, right?
Yeah,
like you were saying, it was gaming. It wasn't like freaking like I don't know what it was, like the A100s or something. That's what it was around the time. It wasn't data center. Data center isn't as cyclical as gaming, or let's just say consumer products. Because consumer products, like, people buy it based on how much money they got. And during 2021, it's like, let me blow my money and play World of Warcraft or something. So now it's like data center, like the cyclicality is a lot less because there's so much staggered cycles in terms of when companies renew their GPUs, when they renew their hardware and stuff, that it just keeps growing. And plus, when you have the competition of the hyperscalers, like one's got to be better than the other, they got to keep growing, innovating. I mean, I haven't. Matt Garman is actually having an interview with Silicon Cube, which is what I wanted to check out. But the interviews that I've seen is that like, well, Amazon, we need to like continue innovating and we need to continue being the leader. Amazon is the leader, but they're slowly losing market share. But where do you think that other CapEx come from? It's come from Google and Microsoft. Like it's still there.
Yeah.
Maybe we kind of killed this topic at this point.
I would say we just have to keep our eyes, the ears to the ground about a recession, dude. Because like, I'll be honest, the research that I'm doing is not at the fundamental level; it's at the macro level. Because I'm sure this growth.
Well, everything depends on the macro. Like, if we have recession, like NVIDIA is done, or at least for now. Like, no one's going to buy NVIDIA calls when a recession happens. Like, it's going to reset, you know. But you're telling me about 2025. What are your thoughts on 2025, man?
You know, I'm seeing certain data points that worry me. You know, it's normal part of the market cycle. The only thing is it's nothing that's super concrete and think that that it's definitely going to crash the market or anything. But there are certain data points that I'm seeing that are just like they're flashing alarm bells, right? And a couple of examples that I'll give. Number one, this recent like downturn that we just had, it was a growth scare. You know, everyone said, oh my God, growth is slowing down. We're getting into recession, blah, blah. So the market sold off pretty hard very quickly. You know, if you think about human psychology, and this is exactly how things happen. Where you ever played musical chairs when you were a kid?
Hell yeah.
Yeah.
Love musical chairs.
So
I'll be right back. I'm going to get water, but I can still hear you. Okay.
Okay. No worries. So imagine a game of musical chairs. You know, when there's, let's say 10 people and there's 9 seats, you know, the rush to get into one of those seats is not nearly that high, you know, so people will kind of be a little bit slow with their sitting down and everything else. And then when 5 chairs come and there's only 4 people, you know, there's a little bit more of an impetus to get down, to sit down. Right now, we're at maybe 3 chairs and only 2 people left. So, 2 chairs and 3 people left. So the thing is that constant fear that I need to sit down, it's at the highest level that it's been in a while. So when you see these giant market downward moves, these things are what scare me, because that means that the market is thinking that we only have 2 chairs, you know? And so that's why you're seeing people sell off. So a lot of people right now, you know, and a lot of big smart money and everything else, you have to really follow them and say, okay, where are these guys leading the way? Now, one of the things that we all saw was this giant sell-off of a lot of tech companies over the last like 13 with the 13F filings. You saw a lot of people reduce down their exposure to tech. Thanks, dear. And that reduction in exposure is something that we have to keep in mind. Now, why is that? These guys, you know, the reason why they're called smart money is because essentially they do a lot of research. They have teams of analysts doing a lot of, you know, good and fundamental analysis. And then they base their investing decisions off of that. See, when you manage $1 million, you can wait until there's only 2 chairs left, you know, in order to sit down, because you know, you're like the small, skinny kid that can still run fast, everything else. When it comes to these big guys, think about they're like the fat kid, but they're a smart fat kid who has to like figure out like, okay, he's got billions upon billions of dollars to manage, which means that he's gigantic and he has to get into one of those chairs, which means that he has to be smart enough to get into one of those chairs before all these skinny people figure that out, who can move down very quickly. So I think a lot of these guys selling off worries me a little bit, because they are essentially, you know, managing $1 billion. Do you know how hard it is to unload $1 billion worth of stock in a single day?
You know how you
without taking
unload
massive
that?
loss?
You rip the market up, you buy the market up, trigger those algorithms to buy everything, and you sell into that strength. That's how they unload it. They don't unload it by pushing the market down, because that's a problem with these whales, is that they all can't sell at the same time. They have to time it correctly. And they, you know, there isn't someone sitting at a desk is like, okay, sell 1,000 shares, sell 1,000. It's like, no, they literally, they move the market up to sell into that strength. And that's the only way they can do it, because they need the liquidity without pushing the market down. Actually,
or they
there
could
was
just do, or they could go the Bill Ackman route, which is come on CNBC and be like, everything is great. And then they're
buy
selling this
everything.
shit.
Yeah. That's effed up, man. That's effed up. But I mean,
Yeah.
at the same time, and this too, is that these people aren't geniuses, right? I mean, they're not right all the time. They're right most of the time, but they're not right all the time. And they could be dead wrong. And just because all of them are doing it, it doesn't mean that we should prepare for it. In fact, I would argue that they could still have a good amount of selling or a good amount of money moving and stuff that isn't on their funds, and therefore they do not have to file a 13F for it.
See, for me, whenever these guys come on CNBC, I listen to them, but I think of them as like the opposite, right? When they're like super bullish on something, I'm like, okay, what is this guy like? What's the
It
angle
depends on who it is. Depends on who it is.
Oh, dude, all of them are shady as F, bro. So you have to, but you're right. There are some that are way more shady.
Yeah.
So I'd say one, I watched that, but then I watched their 13Fs, because their 13Fs are like open kimono. Like there's no hiding you selling that many shares in the open market, So
I saw that too. Yeah. I saw that in a lot of the 13Fs, where it's like they're selling a lot of tech.
That's what I'm trying to tell you. Like, hey, this is the time that we have to figure out, why are these assholes selling tech?
Scoundrels.
They're trying to crash the market. That's what they're trying to do.
Honestly, that's something that kind of like ran in the back of my head a little bit, is that they can only sell into strength, right? And like they're not selling when the market is dumping. That's not when they're selling. They're selling when the market's ripping. So if you really think about the opportunity, maybe they sold a little bit that brought us down to the lows on August 5th, and the market rallied into there, and it didn't rally at like one day.
Well, no.
It's like 3 days of ripping.
13Fs get filed for June and before.
Yeah, no, I know. It's for last quarter. What I'm saying is like the real time selling that they're actually doing, which we obviously don't know when it's happening. But when the market rips up 3%, that means that some people are probably selling into that strength. Some big money selling to that strength. That's the only time they actually could sell into something. I wish I'm going to share this screen. Do you use Well Wisdom or Datarama?
I use Datarama.
Okay.
When one person does it, Sam, it's a fluke. When two people do it, it's an idea. When you have all of these people selling tech, that shit scares you. And the thing is, you have to ask yourself, why are they selling?
Here we go.
Well, what's the impetus to it?
Like, what are these guys? Profits, dude. Like,
what are these people seeing, bro? What are these people seeing?
Well, I'll tell you what we're not seeing is what they're seeing. Because like, if that was the case, then we would have had it already. But hold on a second here. I got to make this bigger, man. Let's see here. Here we go. Top 10. I got to
wish they had it broken down by sector, man, but they don't.
Maybe by sector, portfolio updates.
By the way, I'll give you guys a really big hack on if you just want to manage a really good portfolio. If you just buy
SLG,
and you can you can actually back test this. Okay, you go up and you see like go higher. Go to the top 10 most owned stocks. If you just buy the 10 most owned stocks, and you just keep resetting it based on every quarter, based on 13Fs, you will outperform the market, guaranteed, hands down. I guarantee it. You will outperform the market. Okay.
The reason why that I was thinking about buying Visa.
Yeah.
Go ahead.
The reason why that happens is because you have this kind of like this cream rises to the top thing. And the thing is, you don't have all the little shitty companies weighing this thing down. So like right now, the top is like Google, Microsoft, the other Google, Meta, Amazon, Visa, Berkshire, Apple. Like just buy, if you just crafted or actually go down and do like maybe the top 15, and you could like kind of adjust that way. Dude, all you have to do is just buy. Oh, get rid of that thing. Let's see.
I don't even know how to, dude. Oh, I gotta
wait for it to go away.
This is like free advertising for them right now.
Yeah.
We got 34 people with deep pockets in here looking to buy Wall Street Watchdogs right now. Let's go.
Yeah.
How do I get rid of this thing?
Just press the escape button and see if X comes up somewhere. You might just have to stop sharing and share it again. Hey Sam, what's going on, man? There you go. Just click the little arrow down and
There we go.
there we scroll
There we
down. Okay, so these are the top 15 companies. Like you can see here from ownership count, 33% of funds they own like
Dude,
GOGGO. Yeah.
This is
And
more than
26%.
50% of people of these 13Fs own Google.
Yeah.
Like,
But I mean it makes
this
sense.
is Google and Google, Class C and
Yeah.
Class A. Like,
No,
I don't know why people
remember,
are so
it's
scared
the
about
same
Google, to be
thing.
completely honest.
It's the same thing. It's just if you combine like the 2%, but even from an allocation standpoint, you could use the same kind of like allocation trend to figure out
You're
like,
right,
okay,
my
what
bad.
percentage
Yeah.
percentage should I own? So I mean, look at all these companies. These are strong fundamental companies that are going to do exceptionally well over the next, however many years. And the thing is, once this thing, like let's say it drops out of this list, you just drop it from your portfolio and readjust the valuation. If you just did that, bro, I mean, we should create an ETF that's just called super investors. Just follow this. This is what the super investors are invested in. You don't have to do anything. We'll adjust the. Damn it, man! I'm giving away a good idea.
Stay with the subscribers, man. Don't.
Yeah.
What was the name of that ETF you told me about? Or it was like just the stupidest ETF name.
There's so many. There are so many.
It was like America or something.
Huh? Oh, like it was based on like patriotism, like patriotic.
Yeah.
ETF, like Patriot ETF. I don't know. I can't find it.
It had some funny ticker.
Yeah, it was. I don't know. I can't find it right now. But basically it was just based on we just invest in American companies, like,
Yeah.
and which is good. I mean, that's fine. But the thing is, like, it's like based on like America first. I don't know.
I forgot what it was called. I looked at it, just like that. That's a good ticker to get. That was a good ticker to get. All right. So what I want to go over in the last bit, I just wanted to just go over the earnings that are happening this week. This week is a pretty big week instead of in terms of earnings. We got I already talked about with on the stream. I talked about Jackson Hole coming up on Friday. I think it's just going to be a nothing burger, to be completely honest. But let's see here.
Wait, I just followed you now? I don't know. I thought I followed you a while ago.
No, it's Kris Patil.
Oh, wait a second.
Yep.
The hold on, go back to it.
What
is it? The fucking like faker, bro?
Right here.
Hold on, no. Oh,
this one.
Who the hell is that?
Kris Patil 99. Who is it? It's you. That's who it is.
No, it's not. No, it's not. Why would I retweet
Yes, it is.
myself?
This is you, dude. You only have 49 followers.
No. That's the point. PETEL.
No, I know this isn't you.
Some guy right now is basically created a Twitter version of me.
This is actually good for you.
Reposted all the shit that I post. Like, look, scroll down. Look at this. It's literally me. And all he's doing is reposting my shit.
You
and the thing is, like, people are commenting.
Yeah, that just takes like a quick script. People are commenting because it's on the repost, but people aren't. They got 49 followers. They fooled 49 people.
Yeah, he's following 322 people. I wonder if he's following the same people on his fake account as I'm following in my real account.
That'd be funny. Okay, here. We got some cool earnings this week. So we got this one on Monday. Palo Alto. How do you feel about that one?
Cybersecurity is always good. I'm sure that they're gonna. I am 100% sure Nikesh is gonna take a shot at CrowdStrike.
Oh, he's definitely gonna. They've taken a shot at him the whole time. George Kurtz has taken so many shots at Palo Alto, especially when it came to deplatformization or platformization. But this is my take on cybersecurity, is that we're going to see a lot less platformization happening and a lot more diversity in terms of vendors that they're going through. I still think CrowdStrike, that's top of the line. Like, that's just the best endpoint security management product you can have. But I think a lot of people, and it was in a survey that we talked about in that stream last time, where is that you're going to have people who are going to be like, I want maybe a couple less products from CrowdStrike, and I'll just buy like it from Palo Alto or Sentinel One or something. Like they're going to diversify their bucket a little bit. And the thing is that will impact CrowdStrike's margins a bit, because they did guide assuming that it'll continue, that they'll continue to gain market strength, which they probably will, but not maybe to the degree they're thinking. That is really good for Palo Alto, really good for them, especially since Palo Alto gets most of its revenue actually from non-competing against CrowdStrike, because CrowdStrike is mostly EDR. Palo Alto also has SACE and also has enterprise security. So one thing that Palo Alto really another company that Palo Alto competes with is really Zscaler when you think about that, or Fortinet. But Fortinet has showed a lot of strength in that sector. So we'll see. I think Palo Alto is going to do really good this quarter, to be completely honest.
By the way, this is one of our Patreon picks, baby. It's recovered nicely. The Nancy Pelosi pick. Yeah. So we bottom ticked this one. So congrats to all the people that have Palo Alto in their portfolio.
Yeah, that was 256. The day after earnings, it was like 256, and that's when we bought those spreads, man. That was pretty crazy. And we didn't publicly announce that either. That we just told them that. So, anyways, I mean, I'm sure that if you're still in the trade now, you could still hold it. But is it like something you have total edge over? I don't know. We'll see. I mean, it's up like 30% from there, so it's probably not the best time to start buying spreads now. But anyways,
right now it's definitely not the time. If anyone wants to check out the DD on this real quick, let me just bring it up. If you go, and this is one of the things I have to share with our Patreon people, and like, because I know a lot of the people on here are probably part of the Patreon. If you go to not a freelancer finance, what am I doing? If you go to the Patreon itself and the thing comes up, right? What you do is you go to search posts and type in CrowdStrike, right? Not CrowdStrike, sorry, Palo Alto. What's going to happen is that you're going to get all the DD that Sam did on these guys when it exactly happened. And this way you guys can see fundamentally like where this company is headed and some of the price.
Yeah, that was a free post that you did, right? So
no, it wasn't free. I didn't do it for free. I kept it behind. Let me see. Let me just double check.
No, I thought that one was or maybe that was the all tiers post.
Yeah, no, it was an all tiers post. But like I said, if you guys want to get good DD on this stuff, Sam is the one that did all this due diligence for us. No, it's locked, so it's not public. But a lot of this DD was really good, and it's worth checking out. So
we should just make that public, since that was some time ago. Yeah, that was some time ago. So the edge really isn't okay. Okay.
All right.
It's up to you. We'll decide later.
We were having this discussion this weekend. Sam wants to give more stuff for free, and I'm like, no, I'm not. And
I want to go platformize. I want to go Nikish on everything. I want to go Palo Alto and everyone give stuff away for free.
No, the reason why I'm not making a lot of things for free, and it's not because I'm a greedy asshole or whatever, but it's because I realized there are people that I will genuinely, like give like my attention to, right? And I'll do it for free. I'll be like, hey, you're my X and X, you have this relationship with me. Let's talk about this thing. I think this, I think that. And I find that they don't necessarily give me a lot of value. There's like, oh, this guy's talking out of his ass, right? And what's funny is the reason why they think that I'm talking out of my ass is because it's for free. If you don't pay for something, there's no value behind it. So people treat it like, oh, this isn't valued something. And I saw this, it's just a human behavior thing. I don't know why it's like this, but if you go to a store and you see a great product on sale, people think there's something wrong with it. That's why it's giving it away for free, or they're giving it a huge discount. And then other things that are just marked up like 800%, people are like, oh my God, this is a great quality product. I'm going to buy this one because this is the good stuff. That's why they're charging $800. And it's like, no, it's if the point of entry is just like $15 a month, if you don't want to get over that hurdle, that's fine. Totally understand. We always do content like this, but the point is, number one, it's unfair to the people that do pay for it. That's I'm always a
that's totally sure that I agree with you on that one. Yeah.
And number two, I don't think that some people will necessarily get the value from it being for free. And I noticed it myself. Like when a lot of people talk and they give out information for free, I was like, oh my God, why are they giving out for free? It must be low quality stuff. In which case, sometimes it is, and that mindset is hard to get over. So my thing is, even if you pay something, it doesn't have to be a lot, even a small amount. It shows that you have a commitment to this thing because you're willing to pay for it. So that's why I've decided a long time ago. Number one, I don't work for free anymore. I don't try to help people for free. And even the few people that I did help for free in my personal life outside of things, I cut it off now. I'm like, no, sorry. Like, I'm not gonna tell you, I'm not gonna talk to you about anything, because there are people that genuinely pay me to get my brain. So I'm not gonna give you just because we have a relationship. But not to mention, because they don't pay for it, they don't necessarily give too much of a what is that thing called? Like attention to it either. Like, you won't believe it. I actually went to like some of the people. I was like, hey, you should look at SL Green, and they're like, bro, I'm good. Like, stop talking. I don't want to hear about like commercial real estate. I know someone smarter than you who told me commercial real estate is garbage. I'm gonna stay away from that. And I was like, all right,
That's
cool.
why I did good. That's why I did good,
Yeah.
because there's some people that thought that, and then it ripped people's faces.
Yeah.
But yeah, snowflakes on Wednesday after close. That's a pretty important one. I think something that's actually going to give us a pretty good eye on how the consumer's doing is Target before open on Wednesday. I think that's a pretty important one. Probably not to the degree as Walmart, because Target is more to the middle class consumer. Walmart's more toward, I don't want to say the lower class, but it does have a lot of concentration in the lower income tier. So if we see that the middle class is pretty strong through Target, I think the market might do pretty well after that, regardless of whatever's going to happen with Jacksonville on Friday morning. So yeah, synopsis, more semiconductor stuff. But for the most part, the hardware stuff is pretty much done. So is like the mega cap, and then we're looking at a lot of software coming up this week. Pretty exciting week for me, actually. Snowflake's a pretty big one. Workday is on Thursday after close. I used to have Workday. Peloton is on Thursday before. Do you think Apple is going to buy Peloton?
No.
I think they will, man. I think they will.
I mean, the reason why I don't think
that's a good move. Good move. It'd be a good move.
Why? Why would it be a good move?
Because it's keeping people in the Apple ecosystem. How much the company's worth? Like a couple $2 billion or something now. It's like an easy win for them. Just like buy this. It's like that's how much they spend like a day of buybacks or something. But right now, what's they're spending 100 billion on buybacks. So like that's like a month of buybacks, right? And it's not like they're gonna lose out on it. That's a lot of people to put into your ecosystem.
Yeah.
I
mean, look, it makes sense, because if you think about how Peloton works, it's a hardware, even though technically speaking, it's a hardware play, it's overpriced hardware, which is what Apple specializes in, right? I don't know. I just don't see the acquisition making too much sense. Apple traditionally
their subscription's expensive though. I have a Peloton.
Yeah.
It's $44 a month.
Really? And you pay for it? You like it? Doesn't make sense.
Well, the reason why I use it is, my wife and I use it, and we used to go to a lot of cycling classes. That's actually how we met. We met in a cycling class, but we both use it.
Look at you, man, hitting on girls at the gym. Be like, hey, what's up, girl? What's up? My name's Sam.
Yeah, she's not just some girl, dude. She's not just some girl. She's my wife. Why would you say that? No, but I mean, it's worth it. Like, if you think about your exercise, like if it keeps you consistent with exercising, then why not? That's you're investing in yourself. That's the way I see it. But I mean, I still think that it'll be good for them to buy them. And plus, like at this point, it's like trading at probably the worst valuation it's had ever. Otherwise, it's going to be probably bought up by some private company or some random company, and they're just going to destroy the entire brand. But yeah, yeah, I gotta head out now. Is there anything else you want to talk about?
No. I think the next episode we should cover a lot of data points that might be signaling a recession in 25, because I've been fundamentally doing a lot of research on that. So I have a lot of DD. Huh?
We should. Yeah. I don't have any data points, dude. I don't think there's gonna be a recession.
We could talk about it, and see if I could convince you. Yeah. We could convince you, but I think this is where we have to use like a community effort, right? the community effort in trying to identify weaknesses in the market can help broaden out like horizons of perspective. So, you're going to say things I don't agree with, and I'm going to say things that you don't agree with. But the thing is, if we can make convincing arguments to the contrary, at least it gets us to thinking, right? And hopefully that's the kind of community that we're trying to build, where we don't just have a bunch of followers saying, "Oh, I will follow you, full master." No, like I want people to actually say, like, "No, I disagree with you, Kris, and these are the data points. And if your data points make a lot of sense to me, I'm all for it. So I think that's one of the best parts about developing community, especially among retail holders. Like once you get like a lot of people together who can kind of like, you know, do good on terms of valuation and figure things out. Like you have this edge that is going to give you the huge alpha going forward. Like here's an example. Like Sam Mercier, he's on here. He's probably working right now. That's what he said.
Guy's the
One of
man,
the
dude.
he's one of the best people to follow. Like a lot of people don't know who Sam is, but he's on my Patreon. I love this guy.
Dude,
Like
we gotta interview
yeah,
him, man. We gotta bring
yeah,
him on.
yeah. Me and Sam, we've been talking for close to a year, almost a year and some plus. And the thing is, guys like that are who you want to kind of like always develop and build a community with, because the thing is they see things that you may not be seeing and you see things that they may not be seeing. And the thing is that sharing of ideas in a close-knit community and space really give you a huge advantage, because not everyone has the time to research every single company that's out there. Sometimes there's companies out there that someone else might be looking at. Like Sam was very early to Duolingo. I still remember the day he messaged me. He's like, "Kris, you need to look at Duolingo." And I said, "Okay, let me take a look." And I was like, wait a second. No, this is a great company with tremendous
Yeah,
potential, and it's
yeah.
the same thing with me and companies like SL Green, where Steve, who's one of my friends, spoke to me about it. I looked at the data. I said, "Wow, this is actually a great company." And then I told Matt, and Matt bought it. And then Matt told some other people, and they probably bought it. But the thing is, that information happened within that community where we all kind of like came to a consensus that, hey, wait a second, no, this is actually a great
Yeah.
place to be. And so a
You
lot
can't
of great
yeah.
companies are around where you
You
find
can't
out
get that in
via this
CNBC,
community.
dude. You can't
Huh?
get that in CNBC. You can't get that in CNBC. The problem is that on CNBC, people are trying to pump their own stocks for their own benefit. And that's
Yep.
why I don't really trust you. CNBC is actually pretty good for sentiment. But as far as like what's
Individual
actually good to
names.
buy, yeah, as
Yeah.
far as what's actually good to buy, it's like it's probably the worst place you could possibly go on there. Unless they're saying like it's good for like some news, that just comes out and stuff. But other than that, it's like, it really is kind of garbage TV. It's for ratings. But yeah, no, I hear you. Like, I mean, if you, Sam, Futbucker, Amit, Steve, Tanner, and all you guys, if you guys all like decided I'm going to sell everything because there's a recession coming, it's like, okay, well, I might be doing something wrong. It's like, or if all of you guys are like bullish on a company, like, I don't know, Palantir, it's like, well, maybe I'm missing something here. But, we'll see. We'll see. Yeah, but we should definitely bring Sam on here. Actually was planning on bringing him on here possibly sometime this week, but we'll keep everybody posted on that one. We got to work around the schedule. Sam is all the way in Europe, so his time zone is a bit different from ours. So it would probably be like a late evening one, maybe a recording that we'll just post later.
Yep.
All right. Well,
All right.
thank you everyone for watching. We
I don't
got
know how
about
many
37
are here.
people. Yeah, it increased by 100% when you join. People got kind of bored of what I was saying, but it's all good. It's all good. If I was worried about people listening to me, then I wouldn't like to talk, and I just love to talk, so it doesn't even matter. But anyways, in case you guys haven't, please like and subscribe to the channel. I guess I don't say that enough, or I forget to say that, but I am saying it now. We got more episodes coming up. I do post stuff on the feed and everything outside of YouTube. But yeah, you could watch the old videos. I got playlists on there and everything. Cleaned up house. Yeah, I also have the other series that I started up. Interviewed Garcia last week. Hidden Edge Pod, the Third Degree is the series. That's basically we bring on someone who's pretty well known in the community, ask questions, bounce ideas off them, hear what they got to say about some stuff. But yeah, we're planning on bringing Sam in next, and we'll keep you guys posted when that will happen.
I agree,
thank
man.
you
Poland
very
is where
much.
it's at. Poland is where it's at. We'll look for some great companies in Poland.
I'll see you in Poland. I'm going to Poland in November, man. We'll see.
You are? Dude, they have a
Yeah, I'm going to
burgeoning
Poland in
tech
November.
scene. They're gonna have
What?
they have a burgeoning tech scene. Dude, like they're literally becoming like a very little mini Silicon Valley in
Wow.
in Eastern Europe. You got to check it out, man. There's a lot of great places right now
I will check it out. I will check it out.
Let me know how it is. I might take the wife and go as well. All right.
There you go. Oh, okay. Okay. We'll do a special episode in Poland. That'll be pretty dope.
Yeah, we'll see.
We'll see.
I'll ask her. Warsaw. That's right. We'll be in Warsaw.
Yeah.
All right, guys. Take care.
All right. Take care. Bye.
We need an outro. We need a good one. Like, it can't be like the Map Money outro that we have with like LL Cool J, but we need a good outro.
I don't want to bust his style, man. Like he's got that outro pretty good on luck. I love that margin call scene too. All right. Talk to you guys later.
Bye.